This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Tommy Lambeth, thanks very much for coming on Talk Your Book. I thought maybe it'd be a good chance to start with a little bit about VP Capital and what you guys look to invest in.
VP Capital was set up a couple of years ago with John So Jr., my business partner. We focus on the small to mid cap end of the market, and not absolutely exclusively, but in general. And we try and pick companies that we think will do well in the short to medium term. So on a maybe a 6 month to 2 year kind of time horizon. We're not sort of specialists in any area, but we're generalists. We have quite an open-minded, opportunistic view about things. So with the ability to go short and long.
And what stock do you want to talk about today?
I'd like to talk about the Reject Shop, which is a bit of a contrarian pick in this market, being a retailer. But I think it warrants a discussion based on where it's traded and most importantly the price, which is in my opinion probably the single largest factor in determining whether an investment is a good one, which is price, obviously.
And talk to me about most of the people watching this would have seen a Reject Shop down their local strip mall, but for those who haven't, talk to me about what Reject Shop do.
Look, the Reject Shop is a small box discounted retailer. Its operations are in Australia. It has around 350 stores nationwide. It owns them and operates them. It's been around since the early 80s actually, and it's been listed in Australia for about half that period, and it was privately owned for the other half. So it's an interesting business. It's struggled in the last few years, which we can sort of talk about why. But that's sort of the broad summary. It typically sells products that are marked in the $3 to $4 kind of average price category, and the consumer on average spends around $10 to $20 on a basket of goods every time they go to the Reject Shop.
And it's essentially got a new management team. CEO's been there a few months, and CFO only just recently joined in the last week or so, I believe. Talk to me about their strategy and what they're going to change to get the stock price back to, I think it was about $15 4 years ago and sitting around the $3 mark today. What's their plan to get it back up somewhere near that high water mark?
Yeah, so Andre Reich and Clinton Kahn, the CEO and CFO respectively. Andre Reich's background, Kmart, Target, strong background in retail, understands the discount space. Clinton's investment banker, worked for a private equity firm across the financials. I think what they're doing here is they're trying to turn the business around from a cost perspective and also return the like-for-like sales to a positive number, whereas last year it was doing kind of 2 to 3% negative like-for-like sales, which is disappointing. So how are they doing that is the big question. To summarise the strategy, it's going back to a strategy that used to work for the Reject Shop about 10 years ago, and when it was in its heyday, flying at kind of $70 a share, as you pointed out, Chris. It's a strategy of focusing on the low cost, core items where they have price leadership in the market, and these are things like your gift cards, your gift wraps, for instance, that you can get for $1, or your tier 2 Cadbury product, which doesn't sell in Woolworths, but you can buy at the Reject Shop, or your no-name biscuits instead of buying Arnott's. So it's about a focus on returning to these products, and as a result, if you can focus on selling these kinds of products that consumers went to the Reject Shop for in the first place, then what you can do is you can create scale, and by creating scale in your cost base, you can therefore reduce your prices on a per unit basis. And so that's sort of broadly the strategy, and that kind of feeds into things like, increasing stock turns, direct sourcing, products from companies, and they're beginning to do that. So let's see if they can turn it around. It's going to be not an easy task, but from I guess how the market's priced it, that it's an interesting kind of risk reward bet in our view.
And their stock turn in their half year results was 4.2 times. What sort of level do you think management can get that up to in the next year or two? And so what sort of reduction in SKUs would they need to assist in that process?
Yeah, so I think they're talking about getting it to 6 to 8 times, and that's an aspirational figure. We wouldn't bank on 8 times. I think as an investor and a fund manager, you would take the most conservative view here, and so maybe it's 6 times. And 6 times to us seems logical because, number one, they've historically achieved a number of 6 times, and we're going back to kind of 2010, 2011 here. The international comps, your Dollar Generals, they do stock turns higher than 4. It's sort of in the 5 to 6 range. So it's possible to do these type of stock turns, and what kind of reduction in SKUs would you need? And SKUs meaning the range of items that you're selling, stock keeping units. We think management are targeting around the 75% reduction of SKUs over the course of 6 to 12 months.
That's a super aggressive amount to reduce the different things selling by up to 75%. Have you seen that done very often before in similar type businesses?
Look, it's difficult to do. I guess if you're doing a roll up or you've got you've got multi brands and multi management teams and multi jurisdictional. But the Reject Shop have one brand, one management team. It's effectively the same business it was 10 years ago, but a bit more complicated. And so I don't see any reason why they can't, at least partially execute it. And I wouldn't be so bullish to assume that they can absolutely execute it to the extent that they say, because of course, everyone likes to aim high. But even if they execute it partially, I think, and we can talk about the numbers, a partial execution is a fantastic outcome for shareholders.
We've seen a lot of supermarkets benefit greatly from private brands. It's a part of Reject Shop's strategy. What sort of effect do you think that could have on their business?
Yeah, look, I think it can lower costs. Instead of paying, more for sourcing your tier one brands, like I was talking about, like your Arnott's biscuits. If you can source private label brands that maybe the cost-conscious consumer will still pay for, because the biscuits are still nice to eat, but they don't want to pay for the brand equity associated with buying the top brand, then it's a win-win. It facilitates the trade, at this end of the market, which, that frankly there is demand for, and there's always been demand for. There's a lot of cost-conscious people in Australia, and I expect that to continue as well, particularly coming into Australia's first recession since the early 90s. I think your average consumer has to look at other options, and maybe they can't always afford the best name brand in the market.
And so what sort of forecasts are you putting around free cash flow for the next 12 months, or return on invested capital? Yeah,
so historically, the Reject Shop's been able to do around $30 million of EBITDA plus per annum. We think less working capital changes and some capex. A conservative number is somewhere between $20 and $30 million of free cash flow per annum. Maybe that doesn't happen straight away. Initially there's going to be some cost write-downs, maybe some one-off costs associated with implementing the strategy. Inventory write-downs, which it's non-cash obviously, but still there will still be sort of some cash outflows associated with implementing the strategies. So to provide a short answer, 20 to 30 million of free cash flow we think is achievable, and that's a conservative estimate with respect to its history.
And then market cap's about 130 mil market cap.
Yeah, it's 130 million. It was below 100 million not too long ago, and I think our average entry price was around $2.70. It's crept up to in the threes now. So rough numbers, Chris. 130 market cap. It's cash on balance sheets around 75, and so you're at kind of 55 to 60 million of enterprise value.
And so that raising they did, you think they'll use that cash for store rollouts? Are there small acquisition opportunities? What do you see that cash going towards?
Look, I think it'll mainly go towards working capital. With, I guess, for a bit of context, in 2019, the Reject Shop did have a working capital problem. They had a working capital funding problem, to be specific. And ANZ Bank in 2019, actually sort of threatened to pull their support, which is a material impact, and it's part of the why the stock, you saw the stock go from kind of $5 back to where it was in 2019. So historically, this business does need to fund higher levels of working capital intra-period. So your end-to-end cash isn't going to always be reflective of the cash required to sustain the business. So when I talk about 75 million, which is the 50 at the end of the last period plus the 25 which they raised, that 75, part of that will be required to fund inventory. So to answer your question directly, I think that the 25 is, from our perspective, is to shore up the balance sheet and also facilitate the execution of this strategy, which may mean higher working capital requirements in the short term.
Now, I had this view that in light of the current challenges in the retail property market and the desire for landlords to get any tenant, let alone a tenant with 75 million bucks cash on the balance sheet, that businesses like Reject Shop or other retailers are going to have significantly more leverage over landlords than they have in the past. Could you see a time when these sorts of businesses, instead of signing a fixed lease with incremental increases, they sign a percentage of sales with the landlord? You can't see a world where a retailer like Reject Shop has that sort of leverage in the near term. Is that fair?
No, I think it's a fair point you make. I wouldn't rule it out, and certainly, without being privy to the individual contracts that TRS has with each landlord, I suspect that a portion of them might be variable, and maybe going forward, a larger portion becomes variable. I think it's possible. I wouldn't rely on it for an investment case from my perspective, but I think it's a relevant point, and it could go to risk, and it probably could go to risk around the balance sheet, and particularly in this environment.
And what do they look for when they're looking for a property to lease? What are the type of things they're hoping to get when they set up a retail store nearby?
It's an interesting question. When I was looking at it, I thought, so I spent a lot of time at Chadstone when I was younger. I'm from Melbourne, and I always saw the Reject Shop, and I always saw it doing very well and very busy. And I always thought to myself, if it's not, Chadstone's relatively affluent in Melbourne. It's probably where the affluent consumers go, and it's probably not suited to a place like Chadstone. And I thought to myself, as I was researching the stock, it doesn't really make sense. And so I think when I was talking to management about it, their point to me was, Chadstone's a very good location, but equally we can find lots of these smaller regional locations, and maybe your small towns, your regional centres, your lower socioeconomic points around Australia where consumers are maybe a bit more cost conscious, and so that's what they're looking for. They're looking for a location and a lease that facilitates those wants.
And in broad brushstrokes, in times like this, if we do have an extended downturn in Australia, we may have our first recession since 1994. In fact, clearly it looks like we're going to. Would you see sales of, value proposition type retailers like the Reject Shop actually increase, or do you think there'd be a softening, aligned with the wider economic conditions?
Yeah, it's a great question. I think part of the allure for us for this stock has been, it is somewhat non-discretionary, and I don't want to use the defensive use the word defensive in the same context as buying a retail stock in this environment, because quite rightly, there are risks, the leases, for instance. But I think if you go back to the most recent data point we had, which was 2009, I guess the closest thing we've had to a recession since the early 90s, the Reject Shop in 2009 increased its sales by 25% and increased its sales on a same store basis by around 8%. So it is possible to make money in a recession, and that's because a business like the Reject Shop should have more of a demand base as consumers trade down, as the economic conditions tighten. So logically, it makes sense. Whether that happens this time, I suspect it eventually might. I think what you saw in March, by the way, which the company released to the public, was very, very high March numbers, and Jan, February, and March were all very high actually, and I think that's partly panic buying driven. People rushing into stores to buy cleaning products and equipment and everything they can. So they've benefited from that in the short term. But on a medium term view, I think the crux of the question here is, can the Reject Shop outperform in a recession? That's really the question. And my view is, I think it does better than most.
Tony, it's been great. Really appreciate you taking the time and walking me through it. I've caught up with you a couple of times now, and love how you can make complex things very simple. So thanks for the time on the Reject Shop.
Thanks, Chris.
Thanks, mate.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.